Late last year, we heard from CoreLogic's senior property economist, Kelvin Davidson, who gives us his latest New Zealand property market update. And what a crazy year we've had. We've seen throughout the year a steady increase in mortgage rates, tightening credit conditions, and signs now clear that the housing market is heading into a downturn. And today we're talking about inflation and mortgage rates going even higher.
It certainly has been a crazy year. And if you go back to, say, the end of last year, I think it's quite striking that the market was pretty hot back then, and people were, I think, starting to say, okay, a slowdown's coming through, it's looking a bit weaker, but not really going so far as to call house price falls. So it's funny how a year turns around, and at that time you probably, households, the average person on the street would probably call you crazy to think house prices could ever fall. Now, a year later, it's sort of just become the accepted norm, and I think there's sort of a sense in which people might think you're crazy to think house prices could rise again. They're just so ingrained in this sort of environment of fall. So it's funny how the mindset changes, and the psychology in the housing market is always a big factor, but so hard to quantify. So it's certainly, unprecedented is the word that people use a lot, but certainly it's interesting times for sure. But I'll get into the sort of meat of the slides. Thanks everybody for attending. It's great to have the opportunity to speak again. I love talking about property, so always happy to do so. And I've probably got some 40 minutes of slides, so hopefully we sort of finish quarter two and have some questions. But yeah, as this slide's got this introductory title slide, the housing market was looking a bit better, or at least a sense of optimism was starting to come through in early October, sort of from the second half of September into early October. People were thinking, okay, maybe mortgage rates here have peaked. There was some signs of first-home buyers coming back. I guess people started to look ahead to the election and thinking, well, could National win? Could they reverse the tax changes for investors? Supply pipeline perhaps not looking as strong longer term. So just a sense of optimism coming back that this downturn, it was reasonable to start thinking about the end of the downturn. Maybe it wasn't over straight away, but at least starting to think about the end of it and the start of the next upswing. However, then boom, along came inflation and massively revised up projections for the official cash rate, and the mood took a turn. And I think really, like I've got here in the subheading, that sense of optimism from early part of October, I think really I get the sense now that it's well and truly gone, and actually people are sort of hunkering down for a bit more of a downturn. And just like I alluded to earlier, that mindset of it's hard to imagine prices ever rising again. That negative mindset's taken over. And I'm conscious that the negative mood can go too far, just like the positive mood can go too far. But yeah, just at this environment we're in now, it seems like that optimism has certainly vanished. So I don't know if this is the absolutely correct phrase, but it does feel like we're into the second phase of the downturn. You had that initial period through most of this year where prices falling, people were sort of not too sure what was going on, a bit of uncertainty. Now I'd probably say we're into a second phase where we're actually, the downturn's pretty ingrained. We've got mortgage rates headed higher, inflation's still a problem. So yeah, I think we've got a bit more downturn to come. So sort of a second phase, if you like. But why is my screen? There we go. So yeah, quick agenda. Current situation, inflation and mortgage rates. So I'll get straight into them on the first slide. A little bit of a look at the property market, where we've been and what's going on right now. Two hot topics: lending conditions and construction, which are pretty high up everybody's priority list at the moment. And then where to next. So obviously it'll be the last slide, but probably what people care about the most. So I'll try and motor through to that if I can. So yeah, inflation. This is a selection of headlines around the time of that latest inflation result. 7.3% inflation in Q2. People were expecting a reasonable drop in Q3 to sort of 6.5, something like that. Still strong, but at least it would be clearer signs of that turning point for inflation. Well, in the end, we didn't get that at all. We got a 7.2% number, so basically unchanged. Big surprise, and it set off some of these headlines here, which, a few metaphors there around fires and fire engines and things. So, it was certainly a bit of a surprise. Kicked off a very immediate and widespread upgrading of official cash rate forecasts, certainly by the bank economists. Previously, people were expecting the peak to be around sort of 4.5%. Those peaks were rapidly revised up to 5% or more. So yeah, the inflation number, I think this has played a big role over the last 4 to 6 weeks in terms of dampening that mood around the housing market that might have been starting to improve a little bit. So yeah, inflation was a bit of a surprise. As I say, meant that people's official cash rate forecasts were pushed up pretty strongly. Now we've got a decision, of course, at 2 p.m. today around what happens next. That could change the game again. But the central assumption at the moment is that the official cash rate will go up by 0.75% today, and so it will hit 4.25% in level terms. But the 0.75% increase would be the biggest rise we've ever had. So quite a momentous day if it happens. And whether it's momentous might depend on your perspective. If you've got a big mortgage, well, you won't be too impressed. Obviously, savers will be a bit happier. So it depends on your perspective. But the OCR could hit 5% or more. So we could get 0.75% increase today, pushing it up to 4.25, and then potentially another 0.75% increase early next year. That's the sort of central assumption at the moment. 3 months away until the Reserve Bank has the next chance to make an OCR decision. So I think today they'll probably want to get ahead of the curve a little bit, get their rate up, and see where we lie when we come back next year. But certainly for now, the expectations are that it will go to 5% or more, and pretty soon. So of course, really, what the key thing really for most people is, well, okay, fine, but what does that mean for my mortgage rate? Now I think to some extent, today's official cash rate decision is probably priced into the markets. So we'll probably see floating rates go up, but those fixed rates may not change too much, because it's already been largely priced in. However, if we get another OCR increase, into early next year, so what we also get today with the Reserve Bank's numbers is their projections, their detailed forecasts for the official cash rate, for inflation, for GDP, for the labour market, for house prices. So I think that'll tell us a lot. And, if the overall tone of their forecast was something along the lines of, gee, we've still got some work to do here, we're still concerned about inflation, then that would almost lock in that next increase early next year. And I think would start to flow through to mortgage rates a bit more. So today's decision itself may not change mortgage rates too much, but depends what they say about the future. If they still retain a pretty sort of hawkish tone, or in other words, they say inflation is still a big concern, we've still got work to do on the OCR, and I think that would mean more upside for mortgage rates. So yeah, I mean, a 1 year fixed rate, potentially, we've got them about 6% at the moment for that high equity, or people with at least a 20% deposit, about 6% now for a 1 year fix. If the Reserve Bank remains pretty concerned about inflation, could easily imagine that 1 year fix rising to 7%, or maybe even a bit higher. So a lot depends there on the banking margins, but yeah, I think there's still upside to come for mortgage rates. So we chart there illustrating all of that. I mean, I think from a borrower's perspective, there's not really much good news here. Whether today we even see a 0.5% increase, maybe they go a bit smaller, or that 0.75, we've also got more to come after that. So there's probably not a huge amount of good news here. We are going to see the official cash rate go up and see mortgage rates rise further too. Now, of course, people rolling off fixed rates from a year ago or 2 years ago theoretically have been tested at those higher test rates. So people should have some reassurance that they'll be able to afford the higher rates. But there is just a sense now that some people refinancing won't have been tested at a high enough rate. So, if you look back through time, the service rates themselves change, and there could be some people coming through who perhaps took out a loan first half of last year, who could have been tested at a service rate of 6.5%, or 6%, 6.5%, something like that. Now, when they come to refinance, perhaps in the next 3 to 6 months, they could be looking at, in reality, a 7% interest rate, which would be higher than what they were tested at. So that's just a risk we need to be aware of. But still, I'm conscious of getting carried away by the pessimism. I think you need to have some balance in these things. And actually, there are still a lot of people who will be okay. Yes, they'll have to curtail spending, but they've been tested at those higher rates. So I don't think it's panic by any means. Just